I'm Greg Leonberger. You just heard from me. I apologize, but I'm back again. You have to listen to me for 15 more minutes. Joining me today is Frank Valle, our lead analyst for fixed income. And we're here to ask the question, should investors add to their core bond allocations? And I'll come back to the use of air quotes in just a couple of minutes. First, we're here to proclaim that bonds are back. And we made a similar proclamation last year at this same event. Frank and I are both dads. We like the same lame dad jokes, and the one we've been making for the last 2 years really is fixed income finally got its last name back. And that's really been justified by hopefully the talk that I just delivered and reinforced by the same chart we shared. Yields are a lot higher, therefore expected return for fixed income is much higher. And we look to fixed income to play three main roles in client portfolios: income, diversification, and liquidity. And we're quickly going to create the case for each one of these. I think you're all familiar with it, but if nothing else, it's a reminder. Let's talk about income first. What we've shown here is the yield to worst for the Bloomberg Aggregate Index. Okay, that's the flagship benchmark for fixed income. It's investment grade. There are a lot of treasuries, there are mortgage-backed securities, and then very highly rated corporate bonds in there. If we look at the current yield at each date going back to the 1970s, the long-term yield is a really poor predictor of short-term returns for fixed income. And we're seeing that this year as well. If you think back to December 31st, the yield on the Bloomberg Ag, or the Bloomberg Aggregate, was about 4.7%. Year-to-date return through August is 1.4%. Okay, so not a lot of correlation there. But if we stretch this out, okay, and take those same yield to worst at each January 1st of each year, the subsequent 5-year forward return matches a lot more tightly with that yield to worst. So as I sit here today, the yield on the ag is 5.1%. The expectation is that on kind of a 5-6 year basis, we expect fixed income returns to match that. Okay, so that's the income side. Now what about diversification? There's a bunch of lines on here. They're moving all over the place. Okay, we have fixed income returns, equity returns. You see them going in a lot of different directions, different magnitude. I'm going to make this a little bit easier. I'm going to graph the 3-year rolling correlation of stocks and bonds. It moves over time. That shouldn't be surprising. Focus on the last 20 years and don't look at 2022 just yet. Negative. That's what you want for between fixed income and equities. When equities go up, bonds go down. When bonds go down, equities go up. Okay? That's why we invest across different asset classes. That's diversification 101. Now, 2022, of course, was an outlier. It was a tough year for bonds, tough year for equities. That was driven by, among many other things, but probably most particularly, higher interest rates. Now, on a look-forward basis, we expect correlation to revert to more normal behavior. It won't be overnight. It's not going to go immediately negative, but we do think that 2022 was kind of an outlier of a year in terms of the elevated correlation between stocks and bonds. Income, diversification, and liquidity. Now, the data series here is titled the U.S. Government Liquidity Index. A lot of you are probably thinking, what the heck is that? I've never heard of it. Quite truthfully, when Frank showed me this chart, I asked him the same exact question. What this really measures is liquidity in the market, in the treasury market. No one can argue the fact that cash is easily the most liquid instrument out there, but treasuries are a very close second. Lower is better here. The lower the number, the more liquid it is. So clearly, liquidity's been a little bit stressed on a relative basis, but this chart is in terms of basis points. So a 2.5 basis point bid-ask spread. As a point of comparison, investment-grade fixed income is 20 basis points. High yield is 40 basis points. What I want you to take away from this slide is fixed income is very liquid. Treasuries are very liquid in particular. Okay, income, diversification, liquidity. How have we typically built portfolios? How do clients typically invest in fixed income? Well, I started these comments by talking about the Bloomberg Aggregate. Okay, it's the primary benchmark for fixed income investors. It's been around since 1976. It has $30 trillion of outstanding value. You can see the credit quality as well as the composition of the index right there in those two pie charts. In today's numbers, the duration is about 6, yield is 5%. That's how we've always done it. But our job as a research team is to ask, can we do it better? Is there a more efficient way to invest in fixed income without taking on undue risk? Or can we mostly maintain the risk profile of the Ag Index, but perhaps create a little bit more upside? And this is when I stopped talking and hand it over to Frank, who is our primary fixed income expert. So Frank, take it from here and start to talk a little bit more about the different flavors and sizes of fixed income investing.
Sure, thanks, Greg. So up until now, we've really had a big discussion about betas. And the beta in this instance is going to be the Barclays Ag. So once you've determined what your beta is going to be, you need to attach an alpha target. And there's a wide range of alpha targets available. At one end of the spectrum, there's very beta-focused strategies which are index strategies that really aren't looking to generate any excess return. On the other end of the spectrum are more alpha-focused strategies, total return, absolute type strategies. But what we're really going to talk mostly about during this presentation is those ones in the middle where you're trying to get that beta, but also some sort of excess performance metric. The first one's going to be core. So a core mandate is going to look to generate excess returns of somewhere between 50 and 100 basis points, and a core plus somewhere between 100 and 150. To do that, they're going to need to take some extra risk, and not necessarily overall risk, but what we're really talking about is active risk. And so on a core mandate, you're going to look to do double your alpha target, so about 100 to 200 basis points in tracking error, and core plus 200 to 300 basis points in tracking error.
You just used the term active risk. This is going to be a term that really drives the concept of core plus versus core and how the two are differentiated. So get a little bit more into this idea of active risk. How do we generate active risk? What are the different methods of measuring active risk?
Sure. So in domestic fixed income, there's really 5 different ways to do it. The first 2 are going to be top-down. Duration decision is going to be the first one I'm going to talk about. And when we talk about a duration decision, are you want to be long or short of the benchmark duration? And it's really just a way to play changes in interest rates. The second active decision that could be made is based on the yield curve structure. And that's really playing the different shape of the yield curve. The next 2 are more bottom-up. The first one is going to be trading, which it tends to be a pretty high IR trade. And then the second one is going to be security selection. So think something like, do you want to own Comcast or do you want to own Disney? The final way to do that is sector allocation. And that one's kind of in the middle. It has some top-down elements along with some bottom-up elements. When we're talking about sector allocation, we're really talking those big sectors within fixed income. So something like underweight treasuries and overweight corporates, that would be a sector allocation decision.
When I opened this session this morning, I said, should investors add to their core bond allocations? And by add, I meant, should they allocate the core plus versus core? And as we think about the core versus core plus and this utilization of active risk to drive the differences between core and core plus, it's really important to understand that it's active risk that differentiates the two strategies and not allocating to certain sectors for core plus and not allocating those to core or vice versa. So go through that a little bit more because I think it's really important to understand that. I think for intuitively, investors might think, well, core plus invests in all these plus really risky sectors over here that a core manager would never touch.
Sure. So I think the use of plus was very much an old way to do things. I think when we first started talking about core plus, you had your core mandates, and what a lot of people just did was slap high yield on the side of it and say, hey, this is our core plus mandate. But the fixed income markets have gotten so broad today, there's a lot more things you can do besides that. When you think about the Barclays Ag, what sectors are really in the Ag? It's really the big 3, and that's US Treasuries, agency mortgages, and investment-grade corporate securities. But there's a lot more things that investors can invest in within their fixed income allocation that people do utilize. Probably the biggest difference when you think about a core versus a core plus manager is how much they utilize. A core manager can use a little bit because they have less tracking error to play with, where a core plus manager can use a little bit more. So the biggest difference between a core manager and a core plus manager is not the level of overall risk, but the level of active risk. So what we did with this chart here is we put along the horizontal axis the standard deviation, which is really a measure of overall risk. And what you can see is most managers align fairly close to that of the Barclays Ag. Some maybe take a little bit less risk, some might take a little bit more risk, but for the most part, they're really within that 4 to 6% range. But what you do see is a lot on the vertical axis, which is the tracking error or the active risk. The lighter green represents the core universe, which tends to be toward the bottom, where the core plus is more towards the top, where they're taking more active risk.
So this really reinforces the concept that core plus versus core, from an absolute risk perspective, there's not a lot of differentiation between the two. When you talk about tracking error and how they're allocating more to some of those sectors than core managers, that's why tracking error is elevated. Okay, well, that all sounds great, but we have yet to meet a manager who comes into our office without this great back test, without this great set of quantitative proof of why it's a good idea. But we have to touch on that, right? We have to touch upon it from an active management perspective. We have to touch on it from a risk and return perspective. Let's start with active management. I think it's widely understood, and most of you out there probably have actively managed fixed income mandates in your portfolios. But let's just confirm that first and talk about core. And then, of course, we're here to talk about core plus, so you have to cover that one as well.
Sure. So what we found in the core or aggregate fixed income space is that active management really pays off. So what we did was we took the Barclays Aggregate Index and then we ranked it within the core universe. And what we found out is generally that performance is in the bottom half or bottom third of the universe. When we did that same exercise with the core plus universe, what we found is the aggregate index is generally in the bottom quartile and oftentimes even in the bottom decile when it comes to performance.
So it would appear that active management adds value for core and core plus strategies. Next, we got to talk about return. We got to talk about risk.
Sure. So the next thing we looked at is how much extra would you get over time from investing into an aggregate versus a core plus. So what we did is we looked back in time and thought, hey, if we invested $1 million into the Barclays index, or excuse me, the Bloomberg Aggregate Index, what would you have today? So if we took it back to 1989, invested $1 million today in the index, you'd have about 5 times that value, or about $5.3 million. If we go back and invest that same $1 million into the average core manager, roll it forward to today, you would have about 6x your money, or $6 million, so an extra 1x on it. Go to Core Plus, invest in the average Core Plus manager, and you would be looking at about $7 million, or 7 times your money, 2x more than had you invested into the index. Generally, when you talk about finance, you can't generate higher returns without taking more risk. What we found when we looked at the core versus the core universe is maybe that's not exactly true. While the most risky core plus managers do have a higher level of risk than the core managers, there's a lot of overlap when you look at the core universe and the core plus universe when it comes to overall risk.
And of course, you can't talk about return by itself. You can't talk about risk by itself. You have to integrate the two. Of course, that's a Sharpe ratio, commonly known as risk-adjusted return. And before Frank goes into the details of this, just intuitively as you look at this is not growth of $1. This is rolling Sharpe ratio over time. So you're going to see it go up. You're going to see it go down. But it's really the relative placement of the 3 data series.
Sure. So the Sharpe ratio is a measure of risk-adjusted return. And so is the risk worth the return? Or is the squeeze worth the juice in fixed income? And we would say that it is. So generally speaking, when you look at this chart, the bottom line is the index, so that would have the lowest Sharpe ratio. A core mandate would be in the middle, and then a core plus manager would have the highest Sharpe ratio.
Active management pays off. Return looks attractive. Risk looks favorable, especially when we talk about risk-adjusted return. Got to talk about fees, right? Again, the best investment strategy in the world, if they're going to charge you an arm and a leg to offset all the extra profit you're getting out of the market, never worth it. Talk about fees.
Sure. So fees in fixed income are relatively low, especially when you look at your broad asset class. But indexed fixed income isn't free. There still is some cost to it. I would expect most people would pay somewhere between 4 and 10 basis points in order just to get the index. To get active management, it's a little bit more, but there's really not a lot of difference between core and core plus. You're probably going to look at paying somewhere between 15 to 25 basis points more in order to get active returns. And when you get for that 25 basis points extra, you'd be looking at getting somewhere between either 50 and 100 for core plus, or 100 to 100, 50 to 100 for core, and 100 to 150 for core plus.
So the takeaway is, even though the fees are a bit higher, on a net basis, Core Plus is paying off. I think we've done an okay job so far of illustrating why Core Plus may be worth a conversation with your committees, but I know there's still some doubters out there, so we want to address a couple other preconceptions. The first one is audience participation. And I can see everyone rolling their eyes already and saying this is going to be really lame. I promise you it's not going to be that hard. We've shown 2 strategies up here, Manager X, Manager Y, and shown their allocations across the different sectors in fixed income, okay? One of these is a core manager, one of these is a core plus manager. Now, based upon what you've heard from myself and especially Frank, how many people, to show hands, think Manager X is a core strategy? So everyone else thinks it's Y? I'm just making sure. All right. Well, that was actually way better than the testing we did with our own firm. So I guess you guys know better than us. But again, to me, I think there are a few surprises here. So talk a little bit about the differences.
Sure. So what we did is we looked at a core and a core plus manager, and we broke their sector allocation apart. And not surprisingly, most of the assets are in those big three, right? Which is the green lines: treasuries, investment-grade corporates, and agency MBS. So that's where the bulk of the assets are going to be held in both of them. The blue actually represents kind of those more niche areas within the ag, areas like non-corporate investment grades, asset-backed securities, CMBS, emerging markets. Both of the managers both play pretty heavily in those sectors. The bottom, which is represented by red, are those sectors not represented by the Bloomberg Aggregate. Again, both managers heavily utilize assets in that space. Probably the biggest difference between those two is really something that's not shown. So the Core Plus manager is actually PIMCO Total Return, their strategy. That strategy does a lot in both duration and curve, so they're able to generate a lot more active risk in areas outside of sector allocation. Conversely, the core manager is Dodge & Cox discretionary core. That strategy tends to rely more on sector and security selection to generate alpha. So while the two sector allocations are relatively similar, what they're doing outside of the sectors is pretty different.
For a lot of us, 2008 seems much more recent than 15 years ago. And I remember when I was at Marquette during 2008, a group of us, consultants and research team, would sit down, and there were always a variety of issues we talk about every morning at 7:30, addressing what we're going to share with our clients and kind of what the most recent news was, or things that were kind of hitting the headlines that no doubt had to be discussed with our clients. And one of the big ones was Core Plus. There's some Core Plus strategies, one in particular, that saw a lot of market drawdown in 2008, and I think for better or worse, a lot of investors always associate Core Plus in times of market stress with this individual name. So the leading question to this slide is Core Plus the same thing as Drawdown Plus in times of market stress? Touch upon this individual manager as well as just the broader implications and takeaways in 2008.
Sure. So everybody remembers Western Asset. I think it's an easy target for people to point at when they think about Core Plus. For a couple of reasons. One, it was a very large strategy. That's a $75 billion strategy in 2008 that underperformed by almost 15%. So a large manager that underperformed, so it's very recent in everybody's mind. What do people forget? So people forget a few things. One, the ag was actually up in 2008. It was up almost 6%. There were two core strategies that did even worse than Western when you look back at the results from 2008. In addition, there were 23 managers that underperformed in the core universe by more than 10%. So even if you were in core, you could still see a fairly large drawdown. And this is kind of, when you think of after 2008, what came next. So Western had some losses. Lots of those losses were actually really mark-to-market, price volatility. They didn't sustain any permanent impairments. And so what you saw over the next 5 years is Western actually outperformed the index by about 5% over the next 5 years annualized.
Okay, the last preconception we want to address is a lot of you have probably built your fixed income portfolios using a core satellite philosophy, where the ag is really the core of that fixed income composite. Then you have satellite allocations to some, if not all, of emerging market debt, high yield, and bank loans. As we talk about Core Plus and a higher level of active risk in some of the sectors they might put a little bit more of their assets into, talk about how Core Plus reconciles with this core satellite approach that we've built over time.
Sure. So I don't really think this changes much. When you think about the core satellite approach, that's really a decision on betas. What betas do you want to hold? When Greg and his team does that, their asset allocation studies, that's all based on index data, and so you calculate which betas and which percent you want to hold. So he'll get a percentage in the aggregate. You'll get a percentage in high yield. You'll get a percentage allocation to loans and EM. The next step is really whether you want core or core plus, and that's more of an alpha decision. So you could still stay with your core satellite approach, but maybe as your core, you might want to use core plus instead of just simply a core mandate.
So as we wrap up this conversation today, a couple of things to remind everyone that we've shared with the group. Active management pays off in fixed income. Core plus versus core. Higher upside without the commensurate downside. Yes, there's more active risk, but for an absolute level of risk, it's not a one-for-one exchange. So that could be a reason to think about Core Plus for your portfolios. At the end of the day, do our investors want to add to their core bond allocations? Do we think Core Plus makes sense? And I'm going to give you the famous consultant answer. It's 2 words. It's really short. It depends. It really depends upon what you're looking for out of your fixed income portfolio. If it's purely liquidity, purely just to hold the value, a source of liquidity to fund the cash needs, then maybe Core Plus may not make the most sense. For those who are looking for a little bit more upside with their fixed income portfolios, you can handle a little bit higher tracking error, Core Plus may be a worthwhile conversation to have with your committees. That's the conclusion of this particular session. Up next, I'm going to ask Brett Graffey and Griffin Gilday to come up, and they're going to share with us the current outlook for real estate. Thank you.